Good morning and welcome to today's webcast, Unrelated Business Taxable Income, Overview and Tax Reform's Impacts. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And I'm pleased to introduce today's presenters, Patty Mayer and Pamela Alexanderson, both the directors at Moss Adams. And Patty, I'll turn the line over to you to get us started.
Okay, very good. Our agenda today, we're going to look at just an overview of unrelated business income. What does that mean? Some of the rules associated with it, trade or business regularly carried on, unrelated, statutory exceptions to unrelated business income, debt-financed property and what that means, allocating expenses to the unrelated business income activity, the Form 990T, and then the last part of our session, Pam's going to be teaching that one, and it'll be probably 20-25 minutes towards the end, and she'll go over tax reform changes that affect unrelated business income. So we'll get started here. Okay, so unrelated business income, taxable income, got added into the Internal Revenue Code in 1950. It was kind of interesting because they wanted to eliminate unfair competition with the commercial for-profit sector. And what got a lot of attention back then was a university received a noodle factory as a donation. And I think it was on the East Coast, it might have been Boston, but they were wiping out the competition because they were not paying taxes and they offered a much lower price. So the commercial for-profit folks, they got really upset. So the IRS wasn't upset that nonprofits could have an unrelated business activity. They just thought it should be fair across the board. So if you have unrelated business income, tax-exempt organizations would be taxed at corporate tax rates or trust rates if you're formed as a trust. And the net income, this is income that is not furthering your exempt purpose. Looking at the unrelated business activity rules, there are 3 main components. And you have to have all of the three of them to have an unrelated trade or business activity. So it's a trade or business, rises to that level, it's regularly carried on, and it's unrelated to the exempt purpose of your organization. If you're missing just one of these three, then it would not reach unrelated business income. So you'll want to look at each particular component to see, gosh, is it related to our exempt purpose or is it not? We don't do it regularly, all those things. Then you would not have to pay tax on it. So a lot of people think, oh, but this revenue is helping my exempt purpose. So they look at the destination of the revenue rather than the source. The IRS is looking at the source of revenue, because even if the money is used for the exempt purpose, that doesn't help you get out of these rules. So looking at a trade or business, you want to keep really good records, like, what are we actually doing? What is this new activity? Do we want to make a profit? What is our intent? Because you can have a trade or business and it has losses, but there still could be a profit motive, because a lot of startup companies don't make a profit right away. If there is a net operating loss, you want to look at, hey, is there a strong history of net operating losses? It still could be an unrelated trade or business. They would look at your income before depreciation expense and charitable contribution expense and see if it's, does it really have, are those expenditures pushing it into a net loss or not? And then have you made any changes in the way you're conducting the activity, cutting costs, trying to make a future profit that could lead it more towards a trade or business? And with all these rules, keep in mind there's a lot of exceptions and a lot of court cases and private letter rulings trying to help identify maybe your fact pattern. Does that fit into another area, and how did the IRS rule on it? So it can be really a study to see if it reaches that level or not. We do that all the time. Another component is regularly carried on. So they're going to want to look at how frequent is it, and is it done every year? Unfortunately, there's no clear test to this. You look at the facts and circumstances. You also look at, was it done comparably to a commercial activity, like maybe a fair or something? Is it connected to that where it's just an activity once a year, or a golf event that maybe you're providing services or parking for the event, all sorts of things. You want to look at the commercial side. Is it seasonal, reoccurring, things like that. The last component is related versus unrelated. So to be related, the activity has to contribute importantly to your exempt purpose, not just that it generated revenue that you can use. Does it help you further your exempt purpose? So it has to have a substantial causal relationship. Some of the main things to look at, and when we're advising our clients, is, well, what did you tell the IRS you were doing when you applied for exempt status? That's filing your Form 1023, and now you can do a 1023-EZ. But still, like, what have you told the IRS? What do your bylaws say? What are your articles, or however you're formed, your trust agreement, something? What is the purpose in there? You may want to, if it rises to the level and maybe what you're doing could be related to your exempt purpose, then maybe you need to amend your bylaws, because you can capture it and it makes sense. It's following what you're doing. Also, when you file your Form 990, if there's a change or a significant activity that's been done, or if there are changes to your organizational documents, you describe it within the Form 990. So that is also informing the IRS of what you're doing. You'll also want to, let's see. I'm sorry, I got on this slide. So the other thing is, we're going to go to the next slide. Sometimes an activity can be both related and unrelated, and that's where maybe you have a building and it's used in both exempt purpose activities and unrelated activities. So, for example, you have a museum that has a theater and it shows educational films, which makes sense, but then it also has commercial type films. So the commercial side could be unrelated business income. But are the commercial films really connected in some way with your museum? You know, can you bring a relationship there? The educational films would most likely not be unrelated business income, where the commercial films probably would be unrelated business income unless you can tie it in to your exempt purpose. There's many statutory exceptions to unrelated business income, and we'll go down the list. The first one is the volunteer exception. If substantially all of the work to conduct this activity is performed by volunteers, then it would not rise to the level of unrelated business income. Substantially is about 85% of all the work is being done by volunteers. So that's a really nice exception that you want to take advantage of if you have a large volunteer base, to carve that out. Another one is called the convenience exception. And this is where the activity is really done for the convenience of members or students or patients, officers, employees. So if you think of a hospital that might have a cafeteria there to feed people, feed the guests that are coming to the hospital, or the pharmacy that is selling drugs for the patient's use, that would be related. If they are advertising and trying to draw in the general public and they're really competing at a commercial level, then they could have dual use, where part of it is unrelated, part of it might be related. So you always want to know if you're using the convenience exception, like who is really using these services. Another one on this slide is called the thrift shop exception. So these are your AMVETS goodwill. It's merchandise that is donated to an organization and they're selling it. So substantially everything in that store has been donated. So the sale of those items are not taxable as unrelated business income. Some of the common ones that people are pretty aware of are your portfolio type income. So your interest, dividends, royalties, annuities, things like that are generally not taxable. Royalties, if there's no substantial services connected, then those can be exempt. But you need to watch out for these type of payments if it's in between a controlled organization. Then you have, you've created, one of them would have unrelated business income. So for example, if you have a taxable subsidiary and they're paying interest expense, so they're taking a deduction on the taxable return, and the parent nonprofit has interest income, that interest income, because it's with a controlled organization, would be subject to unrelated business income. So the IRS is not going to let you create multiple entities to avoid tax. So you want to watch out for those. Gains and losses from sale of property, those are exempt. So your capital gains, sales of stock, things like that, as long as they're not inventory or assets used in the trade or business. Real property, so rent, is generally non-taxable, and this does not have services or fixed fee arrangements, and it's not debt financed. So you could have the rental of property where you're collecting rent based on the gross revenue of the tenant, but it can't be the net profit of the tenant because that looks like you're more connected with them and their success, and that would not work. Qualified sponsorships is an exception, and there's no expectation of a substantial return benefit. The next slide I have what I call my cheat sheet, and it's pretty nice because it just kind of goes over the basic rules of qualified sponsorships, and a lot of organizations face this with their galas or events that they're doing. A qualified convention and trade show activity, those activities are going to be exempt. Qualified public entertainment activity, and then bingo games are exempt if they're legal and they're done. They're not regularly conducted by for-profit organizations in the same area. So bingo is a nice one. We actually worked with a client just recently, and they had been conducting bingo, and in one location it worked out that volunteers were conducting all of the services, so that actually helped them. And then bingo is kind of interesting because of the electronic age. Like, they really go into the actual gaming. Is it pull-off tabs? Is it this? Is it that? So it's quite interesting how that can get pulled in and be taxable if you have a certain form of how you're conducting this. Okay, so qualified sponsorships. So when you have a qualified sponsorship, someone is paying you money, and you typically have a sponsorship agreement. It's nice to have an agreement and to write down all of the return benefits that the sponsor is getting and assign a value to that. So what you're doing by that is you're documenting all of the elements within the contract, and then you evaluate each one. Would that be unrelated business income to the organization or not? And the residual that's left over is really the sponsorship non-taxable portion. What the IRS is really looking at is advertising. Has this company really, are you just really taking this money and you're advertising for them? So in an acknowledgement, you can use the sponsor's name, slogans, their location, phone number. You can have value-neutral descriptions. You can have product, service listings. You could, if it's a car dealership, they could bring a car to your event and display the car. What you cannot have is qualitative or comparative language, any indication of price, savings, or value, endorsements, or inducements to purchase or use products. So you could have, the sponsor could have this great acknowledgement, like, we're proud to support the ABC organization. They are amazing. $5 off if you call us, something like that. You're inducing the person looking at it to give you a call. So that would move to an advertising bucket, which would be taxable most likely to the organization unless volunteers are all doing this, something like that, if you can get another exception in there. So those are always interesting. Let's see. Okay, within a qualified sponsorship, if there's a single message that has both advertising and an acknowledgement, then it is considered advertising. You don't split it up 50-50. So once you've got that hooker in there, endorsement or anything, you've converted it to advertising. It does not include the sale of advertising or acknowledgments in periodicals. So if you have a periodical and you're advertising in those, or these exceptions do not apply. So you need to be careful with things like that. But if you have, this is a really nice one where you see it quite often, if you have a specific event, like you're having a gala, dinner, banquet, some sort of a thing, and you have, they have a booklet that talks about the event, the auction items, lists the sponsors, things like that. And maybe there's a page that you buy as a sponsor, and you can, say we're proud to support blah, blah, blah. As long as you're controlling and reviewing what the sponsors are putting in, you can help monitor that you haven't created any taxable advertising within that dinner program. Okay. Now we'll move on to debt finance property. So this occurs if I think the most common way is to think of real estate. When you purchase real estate, if part of it is acquisition indebtedness, then rental income that you get from this property might be taxable unless it's just a small percentage. You fall into a different exception. So you look at a ratio, you look at your average debt over the year and divide it by your average basis of the property to come up with a percentage, and then this percentage is multiplied by your net income. It can be, the thing to be careful with is it just doesn't have to be just real property. This could be margin debt in a brokerage account that you're buying on margin. Now you've triggered investment income to be taxable. So you want to be careful with that. Here's just another slide about how you're computing this. The average acquisition debt is a monthly calculation where the average basis, tax basis of your property is beginning of year, end of the year. Now, if substantially all of the property is used in your exempt purpose, then your rental income, that percentage that's not, would not be taxable. So here you want 85% of the building is being used for your exempt purpose, then you don't have to worry about the other 15%. Pension plans and benefit plans, some universities, they're exempt from the debt finance rules with real property, but there also are requirements inside that exception. So in general, they're usually exempt most often, but you do have to go through an analysis to make sure that applies. Gain or loss. So say you have a building, you've used acquisition debt to purchase it, or later on you've taken on more debt to do substantial improvements, which that would still qualify as acquisition debt. If you're selling it, your gain or loss on the sale is going to be taxable unless the debt has been paid off 12 months before the sale. So if you can afford to do it, that would be great. If you could pay off the debt first, then not have to pay tax on any gain.
All right.
Okay. Go ahead.
Looks like we come to our first polling question. If your organization incurred margin interest expense on its investments, could this be non-taxable dividends and interest, debt finance, income taxable as UBI, or none of the responses above? I'll give everyone a few moments to make a selection. If you're having trouble seeing the poll, I recommend trying to refresh your browser with F5. And to participate in our polls today, please click the button next to the answer you choose and click Submit. And let's take a look at the results. Patty, back to you.
Okay. So the correct answer is the middle one, that it would be debt financed income taxable as UBI. So these are a lot of tricky rules with this stuff. Okay, allocating expenses. When you have an activity that has unrelated business income, you want to obviously allocate your direct expenses that you can completely identify. But you also have indirect expenses, and you want to look at allocations. How do you do that? Well, you can look at, timesheets or tracking. If we have one person that works 50% of the time in the exempt purpose activity and 50% of their time is with an unrelated business activity, then their compensation and benefits would be split 50-50 between the two. You could also look at square footage. Now that would work well with rental property. What is the square footage of this building that's being rented compared to the overall square footage. Gross income, you can look at that, or any really reasonable, consistent method that makes sense you're allowed to use. So in looking at what the IRS is looking at, they're saying, all right, you have this income and you've allocated expenses. How do we know you haven't over-allocated? So they look to principles that are under the transfer pricing principles, and then they also look at Section 482 during examinations. So the IRS could come in, do an examination, and if you don't have like a methodology set up that makes sense and you're consistent, they could really come in and say, well, we think you're wrong on this allocation, and argue with you. So you want to have enough support that makes sense and you've come to a good conclusion and you feel comfortable about it. So, and in thinking of this, you'll see when Pam goes over tax reform, the IRS has been watching unrelated business income for quite a while, and they really took attention with the college and university report about unrelated business income activities, losses that were being incurred. A lot of organizations said, yes, we have this activity, but oh, darn, we have a loss, we don't owe money, and they consistently would have that. So the IRS is okay with you having an unrelated business activity. They're not objective to it, but it can't take over your exempt purpose. It can't become the primary activity of the organization. And if you owe tax, they want you to pay tax. So what do you look at if you're trying to do this? Well, there are transfer pricing studies that you could have, and they look at comparable industries. What's the mean? Are you within the right range? But if you just take a logical approach to this, it's called the arm's length standard, that you are doing this unrelated parties, you would have the same effect. So even though it's the same organization, you're allocating really between departments. So if you were working with a third party, would that make sense? Would those expenditures really work? So that's something to keep in mind. Why are these important? You don't want the deductions disallowed. You could have penalties and interest, adjustments by the IRS, and just how the whole management and your board is looking at everything. Are you distorting how the exempt activity is being conducted because you have too much expenses over in the unrelated business activity bucket? So you want a clear picture of your activities to the best you can. Documentation is really key. You want to have a lot of documentation, memos, whatever you can come up with, and think of your successors. They may just pick it up, do it the same way, but do they understand why? So these are some things that you can think about that you'd want to substantiate. They're all good stuff. The Form 990T. Now, this is the form. You may or may not have ever filed it, but it is a really short form compared to the full 990. But as you see here, there is a standard exemption of $1,000. You look at gross income, direct and indirect. There's controlled group things. They talk about foreign bank accounts, exempt interest. There are credits that you might have that would be available, like a small employer health insurance premiums, the FICA tip credit, and foreign taxes are very common ones that you could see. And then you have special reporting for different types of activities. There are schedules that you would attach, but they're not a full page by themselves. They're 5 pages. They're just incorporated within the form. looking at certain things that we've kind of discussed. We've gone through a lot of these. Compensation for officers, directors, trustees, that's allocated to this. They want detail on that as well. Net operating losses. Now, net operating losses, it's okay to have a net operating loss. The rules are very different that Pam will explain to you with tax reform, but what I'm going to say still really applies. You want to, your prior year net operating losses that have been generated, what's been utilized and what's remaining? Do you know where you are with that? You want to make sure that your net operating losses are offsetting the right income generating activities, and you want to keep all records of your net operating losses in case of IRS exam. Now, that's kind of a hard one because the net operating loss can be carried forward 20 years. So when you're going through document retention, you really should think about your unrelated business activity portion and your net operating losses. Have you kept enough records if the IRS walked in that you could prove you really did incur these losses? So keep that in mind. It's a longer period to think about. Charitable contributions. This is, if you're an organization and say you provide grants to other organizations, then this would be considered a deduction as if you were a corporation or a trust. So if you were a corporation, you would get a 10%, there's a 10% threshold based on your net income that you can take a charitable deduction. If you're a trust, it can be up to 50%. Sometimes in planning, organizations, and I see this more in the private foundation area, but they know that they're going to have investment activity and they want that 50% charitable deduction for the unrelated business income that's coming through from K1s or alternative investments, things like that. The other thing when you're, and I think the state UBI filing and taxes, this really grows quite a bit if you have, like your endowment has a lot of investments and partnerships and different things that are generating. You really have no control over it, but if a partnership had ordinary income and that ordinary income is not related at all to your exempt purpose, you know, maybe they are, they're selling gadgets and that has nothing to do with you. You're a community foundation or something, or you're a symphony. You're not, your exempt purpose is not to sell gadgets, but it's a very profitable investment. So your portion of that ordinary income that's allocated to you would be subject to unrelated business income. Well, a lot of times within the K1, that's the form that you get that allocates the components of the revenue and just all the component buckets that's inside a partnership. Does it have interest income, ordinary income? It breaks it all down. Also, sourcing of states can be included. And you want to take a look at that and decide, do I want to file in another state and maybe it's a loss? Do I want to file and capture that loss and now have a net operating loss in that state because I think it's going to flip and I'm going to have income later on? Do I ignore it? And then the states are going to start sending me notices, possibly, if it's substantial. We are seeing more states getting aggressive when they can identify that a nonprofit does have taxable income within their state. So don't be surprised if that does happen to you. But you'll definitely want to consider how are we going to handle the states. And maybe it's so small, it's administratively, you've chosen, you know, we're just going to hang on to this. We know there's exposure. We may owe them $25. We'll wait. You know, sometimes organizations think like that. But you want to know where you stand. If you are paying state taxes on the federal return, that is a deduction from your taxable income. And then lastly, be careful if you've never had to use the Form 990T and you do have unrelated business income to report and you owe tax, you need to pay through the IRS electronic federal tax payment system. And you can just Google EFTPS and register with them. I would recommend doing it at least a couple of weeks before you need to make the payment. It typically takes about a week or so to get registered with them, and you never know, it could take them longer. Or you can check to see if maybe your payroll system can make a payment on your behalf or some other way to get the payment in there. And I think we have, another polling question.
All right, our second polling question. If your organization had UBI losses from a partnership, should it consider A, filing a 990T to report the loss and NOL carry forward, B, do nothing, C, consider establishing a NOL in another state, or D, A and C. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we are on our second question. And let's go ahead and take a look at the results. Patty, back to you.
Yeah. I think this one, you could actually have a couple of answers. The one I would go with is D, where you are filing a 990T to report the loss, and then you are also considering, do I need to look at other states and possibly file in that state as well? The only bummer about filing in other states is you can generate a lot of correspondence for them getting used to you filing there. But if it's, if it's something that makes everybody be able to sleep at night, you're paying all your taxes or there is a liability there, then it's still worth it, even though it might be a little bit painful. Okay, Pam.
All right, so we're going to spend the rest of the time talking about tax reform changes. We have had a lot of questions submitted, so I do appreciate the questions, and I encourage all of you to continue to submit questions. We will not be able to answer all of them during this webcast, but Patty and I will respond to all of you individually to answer all of your questions. Patty, there were several questions on qualified sponsorship, so if you could just take a minute and explain what a qualified sponsorship is.
Okay, so a qualified sponsorship, that terminology is per the Internal Revenue Code. You can have a sponsorship with any organization, and you can really do whatever you would like to do. There's no limit on that. What the qualified sponsorship means is that cheat sheet that I have, as long as you're the sponsor, their benefit that they're receiving back, as long as it stays within the parameters of non-taxable, then you are, none of the sponsorship payment would be taxable to you. So if they're restricted to only use their name, logo, they can have their address, they can do product description, things like that, as long as there's no endorsement, inducement, call us, here's a coupon. As long as you don't let them do that type of language, then everything to you is non-taxable. If there is an element that they're getting something back and that might be advertising, the reason you want to allocate a price to that within your sponsorship agreement is you've already carved out the exposure that you're anticipating that might be taxable. And if you've done that analysis, the IRS could walk in and they could look at it, versus if you have nothing, then you've left the door wide open for the IRS to say, oh, well, you thought 10% of this sponsorship payment was non-taxable. We think 75% of it is taxable. So, and again, if it is taxable, you have costs and expenses to allocate to it. So I hope that helps.
Thank you, Patty. Okay, we're going to dive into some tax reform.
Okay, so I'm just going to take over for a second. Pam might have got cut off. But there is a flat corporate rate now of 21%. And also, there is siloing and bucketing of trades or businesses activity. There's changes to net operating loss carryovers. And there are also unrelated business income tax right now applicable to certain employee fringe benefits. So the corporate rate, the top rate was 35%, and now it's 21% for taxable years beginning after December 31, 2017. If you're a fiscal year and part of your year is part of your year is in the old rate and the new rate, you would use a blended rate. And then the other thing to consider is if you have deferred assets and liabilities on your balance sheet and financial statements, those may need to be re-looked at, and an adjustment might be appropriate for the new rate. And I think Pam's back on. Pam, are you back on? Okay. Okay, she's not quite yet. That's okay. Siloing. Now, this is a brand new thing. They actually talked about it in, there was a tax reform discussion draft in 2014 that David Camp had generated. And within that, a lot of provisions are actually within this law. One was siloing activities, meaning, there's another slide on this. But basically, each activity is a standalone, and you determine if there's a profit or a loss, but they cannot be aggregated together to offset all the losses. And here's an example, if everybody can see it, where you have rental income, advertising, and alternative investments. And you can see the advertising has a profit, and the other two, or exactly, the other buckets, well, a couple of them have profits. But if you aggregate all the activities together, there's an overall loss of $165,000. Under the old rules, you would not be paying tax on that because you've had a loss, if you think about it all together. But under the new rules, now you have income. All of the profit columns are going to be taxable. So now you would pay tax of $70,770. You'd have an NOL carry forward for the alternative investment and an NOL carry forward to the rental income. So that's a huge change. Okay, I think Pam's back.
I am back. I apologize. We're having some phone troubles here in my office, so I hope it doesn't drop again, but thank you, Patty, for jumping in. So with respect to the siloing, I'm sure most of you have heard that now, as Patty was going through, you're going to be taxed on your unrelated business income for each separate trade or business. So obviously that's only going to be applicable if you have at least two unrelated trades or businesses. But you may also have unrelated business income tax without specifically having a trade or business. And those are things like fringe benefits, which we're going to go over here in a few minutes. Certainly payments from controlled organizations, that can be taxable to you, but not necessarily a separate trade or business. Debt-financed income, as Patty went through, and then any unrelated business income that you might have from alternative investments. So all of those things may also generate UBIT, but not necessarily be a separate trade or business in which you have to silo. So organizations with UBIT from an unrelated trade or business and taxable fringe, again, you're not going to have UBIT from two unrelated trades or businesses. So because UBIT from fringe is not a trade or business, then you're not going to have the siloing effect. So with respect to some questions that you might have is how to treat UBIT arising from a related trade or business. So if you have debt-financed income, perhaps from different rental properties, are you going to have to aggregate that? What types of income might you aggregate? Are you going to just specifically debt-financed rental properties? Would you have to aggregate personal properties with that? Any dividends from debt-financed property? What about alternative investments? If you have several different alternative investments, are you going to have to aggregate those together or report them separately? And similarly for multiple activities within a specific K1. So these are also questions that we have, and we do not have any guidance from IRS yet with specifically how we're going to treat some of these things. So we are still waiting on that. We were hoping to get them by the end of June, and we still don't have anything. And given that IRS just came out with guidance on one of its most important tax provisions that doesn't affect tax-exempt organizations, it still may be a while before we get some specific guidance. All right, so we're to our third question.
Okay. Will certain fringe benefits potentially provide unrelated business income for tax-exempt organizations? And your options are yes or no. I'll give everyone some time to make your selection. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Give everyone a few more seconds to make a selection.
Okay, so overwhelmingly, about 95% of you said yes, and that's correct. That is a precursor here to the next section with respect to fringe benefit reporting as unrelated business income. So before we get to that, we're going to talk a little bit about net operating losses. So in terms of net operating losses, we have a new provision, but that does not apply to NOLs arising before January 1st of 2018. So the provision takes effect for January 1st of 2018. And unrelated business taxable income of the exempt application of the exempt organization after application of the new provision is reduced by the carry forward NOL. So NOLs going forward are only going to be limited to 80% of income. So for those of you who had NOLs and you were used to using 100% of your NOLs going forward to offset taxable income, most likely you're going to end up paying some tax on those unrelated trade or businesses. And they did eliminate the 20-year carry forward and the 2-year carry back. However, we do have a transition period, which we're going to talk about next. So if you had an NOL for fiscal years ending before January 1st of 2018. This is the old rule. You're going to have a 2-year carry back, a 20-year carry forward, and you're allowed to offset 100% of the taxable income in those years. If you have a fiscal year, which I assume most of you do, we have a transition rule. So these are NOLs for fiscal years beginning in 2017 and ending sometime after 12/31 of 17. There will no longer be any carry back. You will have an indefinite carry forward, and for this transition period, you still are allowed to use 100% to offset taxable income. For NOLs beginning after 12/31/17, that's the new rule, there is no longer a carry back. There is an indefinite carry forward, but again, you're going to be limited to 80% of your taxable income, so you'll likely be paying tax on some portion of your unrelated business income. With respect to deferred tax assets and deferred tax losses, I'm not going to talk about this a lot, but just know that if you have a deferred tax asset, it is going to have to be revalued at the new tax rate of 21% as opposed to 35% if you were in the highest tax bracket before. And for some organizations with very large NOLs, it is likely going to have a significant impact on your balance sheet. So you'll certainly want to discuss that with your tax advisor. So we're to our next question.
All right, our final polling question. Beginning in 2019, will tax-exempt organizations be able to use 100% of a net operating loss to offset net income in 2020? And your options are yes, no, or I don't know. It's too complicated. I'll give everyone a few moments to make a selection, and once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. And a few more seconds here.
Okay, and so yes, no, and I don't know. It is a little bit complicated when you have three particular rules: old rule, transition rule, and then new rule. But beginning in 2019, if you had an NOL carryover, you're only going to be able to use 80% of that. So the correct answer would be no. All right, so let's get to fringe benefits. One thing that I do want to preface this by very quickly is that there has been legislation introduced in Congress to repeal some of these particular benefits, these particular fringe benefits as UBI. So just know that I don't have a crystal ball. I actually don't know whether those will pass or not, but there are several congressmen that feel like this is really undue pressure on tax-exempt organizations, and they are trying to repeal some of these. So I wouldn't not necessarily change what you're doing at this point, but the message really is probably just to slow down. Don't make any great changes when it comes to these new tax provisions, because they may actually not exist going forward. But for right now, we do have a new section, which is 512A7, and it does increase unrelated business taxable income by the value of certain fringe benefits that you might provide to your employees. So what they're trying to do here is achieve parity between taxable and non-tax organizations, because taxable organizations can no longer deduct those items. So the value of that benefit provided to your employees for a tax-exempt organization is now going to be taxable to the organization. The fringe benefits are taxed at the same 21% UBI rate. If you are a trust, know that there are different trust rates. And it is effective for amounts paid, or again, I like to say the value of the benefit provided for years after December 31st. Those taxable fringe benefits are qualified transportation fringe benefits, probably most often carpooling, but certain can be highway van pools, transit passes, those things. And then qualified parking as well. So if you're providing parking, and it is a cost to provide parking for your employees to be near your business premises, just understand that that parking may be taxable as an unrelated business income based on the value of the benefit provided to your employees. There is an exclusion if you have a parking lot that's provided really for the safety of employees, but generally going forward that may be taxable. So again, any parking facility would be included, and then on-premises athletic facilities. So these would be gyms that you're providing for the use of your employees and perhaps their families. And the value of that benefit may also be taxable to you as unrelated business income. Now, there might be some technical correction possibilities here with this one, because there is a section of the code that still allows a deduction for those on-premises facilities. So stay tuned for that. The other thing we wanted to talk briefly about is compensation. So as part of the college and university study, one of the things that they really focused in on was compensation. And with this particular one, it's talking about compensation reduction agreements. And there's a publication out there, 15B, which is Employer's Tax Guide to Fringe Benefits, and it'll talk about some compensation reduction agreements with respect to some of these fringe benefits. One of the things you can do with respect to the taxation of fringe benefits, if you don't want to pay unrelated business income at the company level, is you can also consider taxing your employees. But either way, the IRS figures that they are going to get some taxable income with respect to these particular benefits. So if you tax your employees as on their W-2 wages, then those benefits won't be subject to UBTI. So what you should do now is just make sure that you know what you have and what may or may not be taxable. I wouldn't necessarily change anything at this point because we don't have guidance. If you provide sizable benefits to your organization that may generate a larger tax bill, you want to be aware of that, but you want to plan for that carefully just in case some of these provisions go away. Impact on 990T reporting. We're not exactly sure how this is going to be done as well because we just have one 990T form, and if you're familiar with that, it aggregates all types of income, and then you get deductions that take you to a taxable income figure. We do expect the number of 990Ts to go up, but we're not exactly sure how all of these new provisions are going to show up on the 990T. If you are going to be in a taxable situation and you haven't been before, estimated tax payments may be required. Certainly a lot more administrative cost on your part to track some of these things, so just be aware of that. And then for compensation, there is a 21% excise tax that may be due from the tax-exempt organization for employees that make more than $1 million. So the tax is going to be paid on the excess above $1 million. Excess parachute payments would fall into this, as well as 457F benefits that may vest in a particular year could take reportable compensation above $1 million. So you need to be aware of this particular provision. I have not heard anything on this provision with respect to removing it. So this may be one of the ones that you can count on actually really being applicable. It applies to tax-exempt organizations under 501A, and there's a few others here that you can see, but for the most part, 501c3 organizations, if you pay your people in excess of $1 million, there'll likely be an excise tax. Not sure if that's going to be reported yet on 990T or a 4720 for excise tax, but likely to be enacted. So for entity selection considerations, maybe you should have a taxable C Corp as opposed to filing a 990T and having unrelated business activity in your tax-exempt organization. I'll let you read some of those things that you might want to consider with respect to entity selection. But again, at this point, I really wouldn't make a rush to do anything with respect to your entity selection until we know for sure whether some of these things are going to go through. Joint venture might be also another choice of entity that would be favorable towards some organizations. And I know we're getting out of time here, and we do have a Q&A session. I know we've got a lot of questions that we need to answer, but I do need to turn it back over to Emily real quick to wrap up.
Thank you, Pam. And as Pam mentioned, we have a lot of questions in the queue, and unfortunately, we are just out of time today. We will do our best to follow up with you after the webcast. And I want to thank Patty and Pam for a great presentation today. We certainly had a lot of material to cover. And as a reminder, you can download the presentation from the slide deck and handouts widget, which is to the right of the slide view here. If you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts widget to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. The copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.